everybody. It's a pleasure to be here. Thanks, Ibad, for the kind words. Always difficult to speak after a very inspiring set of words from Mirza Yawar Beg. So my talk is going to be slightly more mundane. I think I will be trying to attempt to demystify a lot of the misconceptions about venture capital, which is something which everybody's familiar with, everybody's heard of, but everybody's got a different idea of, different perception of what it's actually all about. So I'm going to begin by talking a bit about what we see of the venture capital landscape in India, what it takes to be a successful venture capitalist in India, and finally, for a high net worth individual portfolio, why does it make economic sense to actually invest in venture capital as an asset class? So again, I think we've heard the phrase disruption multiple times this evening already. So venture capital is actually something which, it's a source of capital which has traditionally always been associated with disruption. So venture capital as a form of capital has been used over the generations, particularly in the Silicon Valley, for creative destruction, for destroying old business models, for bringing new business models to life. And a lot of people perceive that Silicon Valley is more or less synonymous with venture capital. Very few people are actually aware that venture capital is a thriving asset class in all other parts of the world as well. And in India in particular, venture capital is a maturing asset class, which has the potential to give fairly attractive returns, not just for institutional investors, but also for high net worth individual portfolios. So again, just coming back to the theme of disruption. So if we just think about the changes which we've seen, say, not even in our lifetimes, but maybe only in this 21st century itself. So if we take 10 years back and we look at the way we would want to, say, book air travel or book a holiday. So again, 15 years back, 2001, 2002, not that far back, we'd have gone to the friendly neighborhood travel agent. The friendly neighborhood travel agent would have had a DOS-based computer system. He would have plugged some query into it. We would have to take that as the best price available and go ahead and make our booking. Now suddenly, just a couple of years later, you have a whole lot of newer players available. And I think the youth of today cannot believe that the world existed where you didn't have a Make My Trip, a Clear Trip, a Yatra.com, a GoIBO.com, where suddenly everybody knows what's the cheapest price available. And suddenly the poor friendly neighborhood travel agent is extinct. His business model was met the same fate as the dinosaur. He just could not compete. And travel is one domain. You look at, say, something as simple as taxi booking. So I moved to Bangalore in 2011. In 2012, the days my chauffeur didn't turn up, I don't drive myself, so I would actually have to request my wife to drop me to office. It was impossible to get a taxi at short notice. Again, if you wanted a taxi to go to the airport, you booked in advance. And again, friendly neighborhood local taxi rental agency would send a car at an exorbitant price. And he probably thought his business model was something which would last forever because people would always need to go to the airport. And there was no sign of public transport ever becoming available in the city of Bangalore. Suddenly, 2012, 2013, you have Ola coming up, you have Uber coming up, and suddenly that poor guy is out of business. So disruption is something which is often technology enabled, but the common theme across these two examples of disruption which we've discussed are that in all these cases, the disruptors have been VC funded. So the disruptors have been new companies, startups who have come from nowhere, entrepreneurs coming from diverse backgrounds, coming together to actually try solving a unique problem. And venture capital has been the source of capital for such people. Again, this doesn't necessarily need to always be technology enabled. So if we were to take a sort of unrelated industry altogether, so Mr. PC Mustafa is one of the partners at Mount Judi Ventures. If we look at his venture, for example, so if you take even 5 years back and you take, say, something as mundane as idli and dosa batter, I think people assumed that there's no chance of ever making that into a brand. There's no chance of ever that being mass market. It was seen as something that you'd always make at home, or if at all, it would be something confined to mom and pop shops. So suddenly, 5 years later, PC, with the benefit of VC funding and private equity funding, has created a national level brand and goes from strength to strength. And the unique aspect of that has been to spot a gap in the market, and a gap which the consumer needs filled. So as long as those gaps exist, whether it's by technology or otherwise, you will have VCs chasing around to help entrepreneurs actually make the world a better place. Now, I guess the obvious thought you'd be having at this stage is that these are the success stories. So all VC-funded ventures are not destined for success. There will be failures also. So the heart of VC investing is really risk management around a portfolio construct. So you need to, as a successful VC, build a portfolio where your losses are actually offset by your big winners, because every venture is not going to be a success. And factoring in that there will be some losses is an expectation which all of us need to set up front. We cannot hope that every ball will be hit for a 6 or a 4. So you will have wickets which will fall occasionally. And that risk mitigation can be done very effectively through having a portfolio of companies across sectors and with diverse entrepreneurs. Moving on a bit to the life cycle of venture capital deal. So this all starts with the idea. So one of the common misperceptions is that venture capitalists, all they do is they sit in their office, they sit in their ivory towers, and they dream about ideas. And they need to actually just come up with a great idea and match the great idea to a great entrepreneur, and the rest will take care of itself. I'd like to take this opportunity to actually dispel that myth, that there's a lot more that goes into a VC deal. And the investment professionals at VC firms, team including the one at MJV, would include deal sourcing, which means, again, going through a very large number of opportunities to decide which are the opportunities which meet the risk profile, which meet the return profile, and where we feel that the outcomes are most likely to succeed. So this is a game of probabilities. So that filter is very, very wide. So for example, in my last job, again, you'd be looking through maybe 100 deals to get one deal successfully through the gates. That is the sort of strike rates we're looking at. That's the sort of filters which a deal has to go through. And even then, there's no guarantee of success. Even after the great idea has been identified, the great entrepreneur has been identified, there's a fair amount of work around both deal structuring as well as deal diligence. Again, deal structuring is again another area where we have enough myth, and those myths are often around the art of valuation. I say the art of valuation and not the science of valuation because there's no single formula to it. So unlike the solution to an engineering problem or a physics problem, valuation is one where beauty and value lie in the eyes of the beholder. So for example, if we take one of the unicorns based in Bangalore, Quicker. Quicker today is a Bangalore-based company. It's one of the 10 to 12 odd unicorns in India. But if we were to look at financial metrics, the company last year had about 70 to 80 crores of revenue, yet was valued at over $1 billion, so over 6,000 crores. So how do you actually explain these valuations? Again, part art, part science. There's some amount of mystique which sort of surrounds these questions. But pretty much as a venture capitalist, you actually need to spot either the inefficiencies in the market or spot the trends in the market and ride those for the benefit of your portfolio. Again, your other classic story about valuations has been Flipkart. A lot of people have sort of wondered, these people sell everything under the sun, they never make any profit, yet they seem to grow in value year after year after year. And magically, they eventually sold out to Walmart at a valuation of over $20 billion. A common theme across all these names, all these were started by young entrepreneurs backed by not one but several venture capitalists. So venture capital actually, when you get it right, gives you the chance to really compound capital at a fairly amazing rate. Now, all of us will not be lucky enough to get 100 baggers or 1,000 baggers. Even if you get multi-baggers of a slightly smaller size, they're often good enough to give you sort of fairly good returns. The other aspect which is often overlooked really in the sort of in the life of a venture capitalist is the amount of time sort of spent on fairly boring work, particularly say something like what we would call the due diligence in deals. So due diligence again is a very fancy word for actually just verifying whether the entrepreneur is actually walking the talk on all the representations made. So unfortunately, when you have venture capitalists in a rush to do deals, you often have, in addition to the high quality entrepreneurs, you'll have the occasional fraud simply out to make a quick buck to actually take the VC's money and run away. So due diligence is all about ensuring that doesn't happen. Again, not 100% foolproof. So you have the occasional corporate fraud, and these happen in listed companies also. So for those of you tracking the stock market, Vakrangi, 1% beverages have all been in the news for the wrong reasons. But by and large, a well-run diligence process with the right legal and accounting advisors usually can tell you enough to be able to avoid the more nasty cases of fraud. The last bit of the life cycle of a VC is exit. But before we come to exit, I'd just like to spend some time about what happens in between. So the two glamour phases are the times where you have the press release announcing a deal. The other place where you're in the limelight is when you actually announce your exit, where you've sold for so many, hopefully millions of dollars. In between is where all the hard work happens, and a good venture capitalist sees himself as a business partner of the entrepreneur he's backing, and a good venture capitalist has to step up and help in execution. So it's not just taking a board seat, it's not just advising at a strategic level in quarterly board meetings, but it's in helping in every aspect of the business, in attracting talent, in putting together the right ESOP pool to ensure that you have employee stability, in customer introductions, in vendor introductions, even in helping finding sources of capital, whether it's other equity providers or other debt providers. So in all aspects of business, the VC needs to walk the talk, have a operating bent of mind. So interestingly enough, successful VCs, particularly in the US, almost always come from operating backgrounds. Very rarely do they come from a pure financial background. And again, I'm glad to say that from what I can see, at least the Mount Judi team has also constructed its team around that entrepreneurial flair and operating capability. Now, the other question I touched upon at the beginning was really where does an investment into a venture capital fund fit into a H&I portfolio? So again, if we now switch to wearing a wealth advisor hat. So if we look at high net worth individuals in India, they've typically tended to have the bulk of their wealth in their own family businesses. Now, that creates a wealth concentration, which of course is not bad because they are backing themselves. But the flip side is that the surpluses often tend to be deployed in sort of suboptimal investment avenues. So historically, the affluent Indian family has deployed surpluses almost always in real estate, often in gold. And I guess all of you are aware that unfortunately neither gold nor real estate have really given the returns which we would have hoped for over the last decade or so. In fact, gold probably in dollar terms has given negative returns over the last 6 years. And at least large parts of the real estate market have also given very, very mediocre returns over the last few years. So your traditional wealth managers would always advocate healthy allocation to equity. When they talk of a healthy allocation to equity, it's usually in the form of listed equity, which would be your mutual fund, direct stocks, and all of that. But for a sophisticated high net worth individual portfolio around the world, particularly both in US and Europe, an allocation to alternatives is considered standard. And that allocation, while it's on the smaller side, would typically be either to a venture capital or private equity fund. And these give what you call uncorrelated returns. So they are not correlated to the same market cycles which impact your other asset classes. So for HNI portfolio in India, SEBI has actually tried making the framework slightly more rigorous. So we have the AIF guidelines, which were instituted by SEBI a couple of years back, and they are intended to protect HNI investors from effectively being taken for a ride by any fly-by-night operators. So with those regulations coming in, I think we have a fairly good amount of regulation on the VCP fund market in India. And that should hopefully be a big enabler for high net worth individuals to start investing in the asset class. I'll just conclude with a few quick thoughts on what really constitutes a successful VC fund. So I think it's really about good individuals coming together to form an ecosystem. And I think all of us would agree that good individuals attract more good individuals. So effectively, once you have that ecosystem where you have a bunch of good individuals attracting other good individuals, you effectively would have good entrepreneurs attracted to the ecosystem. And the moment you have that ecosystem, then I think the value tends to multiply exponentially. And here, as we've seen, as Sharif Saab mentioned in his speech, I think across the ecosystem with Lifeline, with Rehabar, I think MJV is embarking on a fairly noble venture. And from my side, I've known Ali, who I think is speaking next, for over 10 years now. And I think they've got their hearts in their right place. And that is backed up with a very talented team. So I wish them all the very best. Thank you.